All right, let's just jump right in. If you're in your 30s or maybe even older and you've got that nagging feeling that you're behind on investing, this one's for you. We're going to break down a really clear, actionable plan to help you catch up, not by taking crazy risks, but by being smart and strategic about it.
Man, does this question sound familiar? It's a heavy one, right? It's that thought that can just paralyze you, that makes you feel like the ship has already sailed and you've been left on the dock.
But listen, and I mean really listen to this. You are absolutely not alone in feeling this way. And the even better news? You are not too late. The key, though, is that your game plan from here on out, it's got to be different. You see, when you're in your 20s, you've got this luxury of time to kind of mess around and experiment. But in your 30s, life gets real. You've got more responsibilities, maybe a family, loan payments. You know the drill. Your strategy can't just be random anymore. It has to be intentional. It has to be structured.
So, what does a structured plan actually look like on paper? Let's start with a really simple, tangible goal, just to show you what's possible. We're going to talk about a plan to build a corpus of 1 crore rupees.
The first piece of the puzzle is a consistent monthly investment. You've probably heard of it, a systematic investment plan, or SIP. So let's start with a totally manageable number for our example, 12,000 rupees a month. The second ingredient is time. Time is the secret sauce here. We're looking at this as a long-term plan, okay? A 20-year horizon gives your money the runway it really needs to do its thing, to compound and grow in a big way. And the third piece we need to think about is the return. What can we reasonably expect? Well, for this plan, we'll use an assumed average return of about 12% per year. Now, that's a pretty standard expectation for long-term investments in equity-focused mutual funds. Okay. So you put those 3 things together, that consistent SIP, a good chunk of time, and a reasonable rate of return. And what do you get? Boom. This is the result. That disciplined investment has the potential to grow to 1 crore rupees. So, yeah, building a serious nest egg is still very much on the table. Of course, we've got to remember this is all for educational purposes, and any mutual fund investment does come with market risks. But what if you want to do even better? What if you want to put the pedal to the metal and really make up for lost time? Well, this is where we introduce the Supercharge for your plan. It's called a step-up SIP, and the idea is genius in its simplicity. Basically, as your income goes up each year, you get a raise, a bonus, so does your investment. You just commit to increasing your monthly SIP by a set amount, say 10%, every single year. Now check this out. The visual here tells the whole story. Look at the difference. That first bar is a flat SIP, just 12,000 month after month for 20 years. But that second, much taller bar, that's the step-up SIP. It starts at the same 12,000 but grows by 10% each year. The difference in the final amount is, well, it's staggering. It's the power of making your investments grow along with your career. And this really gets to the heart of it. The most important point here is that you don't need to go out and chase some super risky, speculative stocks to catch up. You can accelerate your wealth building in a systematic way, just by investing a little more as you earn a little more. Okay, so we've got the how much to invest. But now for the big question, where does all this money actually go? That brings us to the blueprint, your allocation model for balancing that growth with risk. At this stage in life, a balanced approach is usually the way to go. So we're looking at something like this, about 60 to 70% in equity funds for that long-term growth potential. Then 20 to 30% in hybrid funds, which kind of mix stocks and bonds to smooth out the ride. And finally, 10 to 20% in debt funds for stability. So you might be thinking, hey, why not just go all in on equity for faster growth? And that's a fair question. But remember, your responsibilities are different now. You need that growth, for sure, but you also need stability. You need some predictability. This kind of mix is designed to give you both. And as always, this is just a model. It is so important to talk to a qualified professional who can help you build a plan that's tailored specifically for you. This brings us to our final piece of the puzzle. And honestly, it might be the most important one. It's all about your mindset. The mental shift you make right now, that's what's going to decide if you succeed or not. First, let's talk about the traps to avoid, okay? The biggest one by far is just delaying things even more. That little voice that says, I'll start next year, it is so costly. Other big mistakes? Panicking and taking on way too much risk. Or, and this is a classic, stopping your SIPs the minute the market takes a dip.
This quote just says it all, doesn't it? The goal isn't some frantic sprint to the finish line. It's a strategic marathon. You've got to forget fast. Your new mantra is SMART.
So here's the bottom line. The one thing I really want you to take away from all this. Stop worrying about timing the market. Stop thinking about the years you might have missed. From this day forward, your single greatest asset is your discipline, your commitment to just keep investing, month after month, year after year. That will have a bigger impact than anything else, period.
So we've laid it all out. The problem, the plan, the accelerator, and the mindset. You have the blueprint. The only question left is the one you see right here. What is that very first step you are going to take to start catching up the smart way? Hey, thanks so much for sticking with me through this. Just remember, all this information is for educational purposes. Always do your own homework, and please consult a financial advisor before you make any big investment decisions.